Oh, yeah.
All right. Yeah. You can see it live?
Yeah, I can see it's alive. So I didn't check my YouTube, but um I can see you. I can see the live button here running with the timer. Red.
Okay. All right. So let's start this. See what's going on.
Let's do it.
If we could, all right. All right. So welcome to the Y Network. And tonight we have a special guest here, Fahim Abdul Razak. He is multifaceted, my brother. He does a whole lot of things, but today we're going to talk about life insurance, and he's going to tell us the dirty secrets behind what they don't tell you. So he's going to really give us some really good some game on how to and I guess know when you're someone's doing the right thing for you, not for them, right? Fahim, like help me out here. Just let me know
Yeah.
if it's exactly what we're gonna be talking about tonight.
Yeah, we're gonna be talking about things to look out for, things to consider when getting life insurance. And we could talk about the reasons why people get it because there's different reasons. So we're going to go into all of that kind of conversation. So I'm looking forward to getting this conversation started.
All right, great, great. So let's start by just give the audience a little bit about background about yourself and how you got started with life insurance.
I got started in life insurance because of life. And what I mean by that is, I lost my mother in 2010 and she had like a policy for $4,000. And $4,000 is not enough to bury somebody. Her funeral wound up costing, I think it was like 11 or 12K. So that was like she was the first person in my family and as adults to pass away. So that was weird and odd. And it's like, okay, $4,000. So I kind of like filed that away in my brain. And I had a policy when I got married and then it lapsed. So that's like, lapse meaning that it ceased because I stopped making the payments, right? And then my father, like 2 years later, my father gets sick, and before he had gotten sick, I took him to the insurance company. I'm not going to name him, but I took him to an insurance company that I had just got my policy with when my mother passed. And I asked him, I said, "Hey, Dad, you got life insurance?" And he was like, "I think so." So what I learned is if somebody say, "I think so," that means they don't have it,
It-
right? I learned that.
Exactly,
So he
because
said,
they would know
he's, they would know, right?
mhm.
He said, "I think I have it on my job." That's what he had said, right? I think I have it for my job. So the thing that I learned from that conversation was, and so I'll jump in and like throw little things that I learned. If you have a job life insurance policy, those policies are only good when you're actively working on the job. They are no good if you own workers' comp or if you are retired. Those policies are no good anymore. So why give a life insurance policy to somebody who's injured and somebody who's retired? You're not actively making a job money. So my dad was retired, so he didn't have it, but he thought he did. Okay, he did think he did. He passed away, and there was not enough money for him too. So that happened, and then I want to say a month after my dad passed, I had a was a grandnephew, you want to call it. He passed. He was a preemie, and then that grandnephew's grandmother passed away 2 months after that, which was my oldest sister. So in that span of time, a lot of people died. I've been to a lot of funerals. I'm going to just say I was like 22 funerals. That's what I remember. 22 funerals. And then in 2018, my sister died. My other sister, Quadria, had passed away. And then 2 years later, so now the life insurance is like on my mind now because I'm like, okay, there's like certain amount of deaths. I believe it was four at that time, two siblings and both parents. So then 2020 rolls around, COVID comes. So I'm thinking about life insurance. I actually signed up to the company then, right? I said, okay, I picked the company. I'll tell you about the company a little later. And my brother Matasi, he goes in the hospital, he dies from COVID. So now it's on my mind, like really, really, really on my mind. And I went ahead and I took the license exam. I studied for it and then I took it. He was the fifth family member to pass, and it's like, okay, we always coming out of pocket. That's what I thought. And I thought that was going to be it for a little bit, but you know how life happens. So in 2023, my younger brother passes away. So all of the deaths kind of like put it on my like front center view. I need to learn about this because I'm seeing GoFundMe's, I'm seeing people, ask for money, collections to bury them. And I was like, I noticed at the funeral home was like, I don't know if them having a payment plan. Like, you got to come up with this money. That's what I saw. You got to come up with the money. Burial is not cheap. All of these things. So I'm like, wow. So um, that put me on the radar to be motivated to get the license. And I got the license, and I've been doing it seriously. I want to say since 2021, like really getting serious. After I was trained, I had to be trained. You had to learn about what's legal to say, what's not legal to say. So getting a license is one part, keeping a license is another part. So that's what kind of got me into it, was a lot of funerals. And just even to let you know, I don't know if I told you this, but in the last 3 weeks, four people I know passed away. One as early as today.
Wow.
Two of them was under the age of 45. So it's, people pass away, and guess what? Life insurance doesn't get you another life. We all know that, but there's a reason for it. And we could go into those a little later.
Definitely, definitely. I could relate. I could relate with you with the when my father passed. That's when we know the value of having a life insurance. And I learned from that as soon as we buried him, I looked into getting insurance for myself and for the kids, because I really feel that it's your responsibility to actually, I say, bury yourself and don't leave a burden for your family to scrape, use their life savings, because that's what happened with me and my father.
Mm,
We all came together, and the money I was saving to actually to buy a home, I had to use it to bury him.
mm,
So life lessons, saying, you learn, and you just hope that you don't want to do the same thing, or get caught up like that again. So try to my whole family, we just said, everybody have to get life insurance. We got some for my mother, and
right.
that's how, you know and that I want to go back a little bit, because you said something, and hopefully you can answer this. But all right, so let's say I'm retiring from my job. Can I roll over that life insurance, or it just ends because my employment ends?
So the one that your job owns, you can't because they
Mhm.
own it. So let's
Okay.
let's go a little to this conversation because people say, "Oh, I got a policy for my job." The job could own the policy, right? So that
Mhm.
means the job picks the beneficiary of the policy, right?
Okay.
That can mean that too. And then the job can terminate the policy anytime they want. So it's always best for you to have your own private policy. And jobs, just
Definitely.
for people who don't know, they have this thing called key man insurance. If you're an important person on your job, that basically the job is like, we really depend on you, they could take out a policy on you in case something happens to you, so they can train somebody else to do what you do, and their business won't have to shut down. Incidentally, Keyman Insurance is similar to a policy they take out on music artists.
Yeah.
Labels take out a policy on music artists. So they like, this guy's making us 5 million a year. We're going to insure him in case something happens to him, that we're not going to be, just shut down and out of money from the income stream he's providing us. So just know that. I just put that out there because I want people to be aware of that.
Well, I learned this a while ago. Anybody could take a policy on you.
Yeah. Yeah.
anybody can take a policy on you, you know. So yeah, I heard a crazy story where, you know, this girlfriends of guys that's out there in the street, they taking policy on them, you know. So
Well,
yeah,
truth be
that
told, like my mother, she had policies on most of my siblings
mm,
because it came up. She had
okay.
policies on most of my siblings. So they say generally you should have a vested interest, meaning you should be a relative or you should be some we're related, but that's not the 100% rule. So, like I said, jobs have this thing called key man insurance. So that right there is telling you, you know, that they don't have to be relatives and all of that.
No, no doubt. You know, I learned this from a guy because um, since my father passed, I was talking with this gentleman, and we was talking about life insurance, and talking about, you know, my son's mother, and she said, "Oh, you could take a policy out on her." That's the first time I heard that.
Yeah.
So yeah. So insurance is big. Insurance
Hmm.
is big, and the wealth use it is a wealth building. I know you're gonna touch on that as well. It's a wealth building asset as well. I mean, no, it's not an asset, but it's um,
It's like a
a vehicle.
vehicle or strategy.
Hmm.
So I'm gonna say,
Hmm.
two people, it is, but not in the way they think, right? Because life insurance a lot of times is being sold as an investment. And I give people homework when I talk to them. So all the listeners out here, if you could take out your phones and go to Google and see, so investments are called securities. That's what they are called. And it's two separate licenses. Life insurance is a separate license from securities. If you Google if life insurance is a security, I'm not going to give you the answer, but I want you to Google it because you have to educate yourself, right? So certain people is like, hey, you could invest in this life insurance. And again, is life insurance an actual investment? So our company has a saying. We say life insurance is for dying prematurely, and investments are for if you so you don't outlive your money, because that happens too, right? So we don't believe you should tie the two together. They should be two separate things. And a lot of us get sold on life insurance policies that they say that are investments. Now I'm going to tell you straight up that FINRA is one of the organizations that regulate life insurance. FINRA. And you're not supposed to tell people that life insurance is an investment because it's actually not true. It's not an investment. Now, how do you create generational wealth with life insurance? That is the income protection. So life insurance was initially called income protection. And what it would do is it would a person would take out a policy. Like today we get policies say, oh, I want a $50,000 policy, or I want a $25,000 policy for burial. That that is not creating generational wealth. That is, you don't want to leave a bill for somebody to bury you. However, if you had used life insurance and said, I want 10 to 15 years of my salary and life insurance that my beneficiary will receive, and you pass away prematurely, your beneficiary will get a check tax free for 10 to 15 years of your salary. And that's how you create the wealth. That's how you do it. But putting it into a policy that, see my little air quotes, accrue value, I'm going to explain that
Hmm.
later. Putting it into that is not how you build generational wealth. Nobody does it that way. So
Yeah, because
it's not an
you know,
investment per se.
yeah, because I know we had a whole bunch of conversations about this during COVID about the Rockefellers and how they used a trust and they use life insurance to build their wealth. Where when someone passes away, the money goes into the trust. So that's how like generational wealth builds.
Yeah. So again, that's using it where you take out a sizable policy on somebody. So most of the policies that I've seen, on average is like $50,000 a year, especially in our community. But this is not exclusive to our community, so I'm making it a broader thing. But $50,000 a year is going to be gone in a year if you pass away prematurely. That's just real talk.
Exactly.
So because
Exactly.
the thing we tell people is this: the mortgage don't stop or decrease, the car note don't stop or decrease that your survivor is handling, but your income stopped
Yeah.
instantly. It just stopped, but the bills is going to keep coming. So somebody had made this comment. One of my trainers, like one of the people who trained me, and it sounds a little harsh, but it bears some going into. So the comment was, life insurance is for people who care about their loved ones. That sounds harsh, but if
Yeah.
you think about it, they're going to mourn you if you pass away, but you don't want them to financially suffer from that.
Definitely.
So it's you kind of tying your horse, they call it, or basically putting your ducks in order, and you saying, look, I'm going to leave something to somebody I care about, because the person who receives the money is the beneficiary, not the person who bought the policy, right? Unless that person is buying a policy on someone else. The beneficiary will receive it. Well, what is it that you want for your loved one? Or want to be able to pay for their college? Oh, so let's go into the reasons why some people get insurance. Some people's for burial. I stated that. Some people is like, I want my spouse or survivor, I want the mortgage to be paid with the life insurance money so they don't have to move out the house, right? I want them to have a certain amount of years of my income. So if they need to retrain themselves, they could go to college for 4 to 5 years, get a degree or advanced degree, and get a new job without having to worry about my side of the income. I want these bills. I want the car to be paid off. I want these things to be paid off. So these are reasons. And lastly, I want to generate some wealth that I didn't have that I'll be able to pass on because I pay for the policy. That's the reasons.
Yeah, no, yeah, like we said earlier, there's so many reasons, that people do, but is it the right reason? You mentioned $50,000. It sounds like a big number, but you could blow through that in a year, depending on
Yeah,
your
fifty
bills.
thousand dollars in bill, like in to go through that is not a lot of money when you think about it on a big perspective. Like, you can't make it last multiple years. But here's the other trip too. There's different kinds of life insurance. There is term life insurance, which is you pay for that like you pay for car insurance. There's no cash value. So if you're dealing with car insurance, you say I'm gonna switch from this company to this company, they don't give you a check back, right? This
Mhm.
is, you use it for that period of time and then you switch to another company. So that's what term life is. Term life is different lengths of time: 10, 15, 20, 25, 30. 30 years you could get this policy locked in. Term life insurance, two things about it, is one of the cheapest for you to pay for, but it pays out the most amount of money. So you could get, for the same price that you have a cash value policy paying you $50,000 a year. At my age, I could tell you right now, it's probably going to be $100 a month. $100 a month. I could get like a term life at my age, and I could have about 250,000 for 30 years or 20 years or whatever, the policy term is. But that's the difference of it. So the term life costs less for me to purchase if I was purchasing, but it will pay my survivors more money than a whole life. Whole life policies, and whole life, they got universal life, index universal life, IUL. Everybody heard of that? That one is almost at the top of the most expensive policy to buy. It's expensive. Term life is price wise. Term life is the most affordable, economic.
Okay, quick question. You mentioned that term. It is it's self-explanatory. With it's a term. It's going to end. Can you, let's say you took a 10-year or a 20-year and you outlived it? Can you extend it, or do you have to do a whole new policy?
No, you can't extend it. So here's the thing, and we're going to tell you about this as well. And this goes with all companies who do it. Term life, let's say you get a 20-year term policy. It's guaranteed for till the age of 95. That's the guarantee, but it's not going to be the same price. So one thing about life insurance that people may or may not know is the older you get, the more it costs to insure you. So they have policies, I'm not going to name them, but I looked into them, I researched them. They have this guaranteed whole life policy that's on TV. It's very famous. They got a man talking about it. I'll just say Alex Trebek used to be from Jeopardy. He used to be the spokesperson for it. And they say, hey, you get guaranteed life insurance, no physical, no medical exams. Those policies are expensive for a little bit of money because of the age of the people applying for it. And then if you do get a policy of any type and you don't take a physical, that policy is going to cost you more because they don't know your health conditions.
Yeah.
So it'll cost you more. And if you do them with a physical and you could get some discounts, you could get what they call preferred plus. I've sold several policies for preferred plus. Like for example, I sold one to a person who's about 29, 28, somewhere around that age range, and they was in great health. And I gave them a quote. I think it was for like $660,000, and I think their quote was like $40 a month for 30 years, and then it wound up being less than that after they did the physical. It was like $32 a month.
Hmm. Because of the
So
physical.
the physical saves you money.
No, no. So the like if you do take a physical and they see some like if you're pre-diabetic or any other conditions, that makes the policy more.
Yes, and I'm gonna tell you what else makes the policy more. If you have a substance abuse problem,
Mm.
if they
Yeah,
detected
like
it
because
in your blood work, because what does that mean? So, and I talk to people about this too, because I give them a real whole conversation. You know, if you abusing substances and you come to me and you say, listen, I want you to insure me, I'm gonna look at you like, yo, you a higher risk because you're not being responsible with your own life. So you want me to cover you. I'm going to wonder how long you're going to live because the insurance company wants to say, so typically I'm going to tell you, insurance companies love insuring people who are in great health. They love it. You know why? Because they're not expected to have to pay out on them.
yeah,
So that's what's the profit of it. But if you have somebody who's not in great health, who's going through health challenges and all kind of things, you're going to be like, uh, I'm going to charge them a lot more money to insure them because I may have to pay out sooner than later on them. Yep.
exactly.
So
Makes
those are
sense. They in
factors.
a business to make money, not to give out money.
Exactly. Exactly.
So yeah, so it makes perfect sense. So yeah. So let me ask you this. So can you, let's say you know that you're not in good health, but you could get there. Should you wait until your health is better, or get the insurance policy and then adjust it? Meaning, go take the physical, or do you have to just cancel that policy and start a whole new one?
Speak up a
Like,
little. I'm losing you.
okay, so can you hear me now?
Yep.
Okay, so I said now, let's say you're not in great health, but it's not terrible health. You could get there by exercising and eating healthy and such. Can you should you wait or get the policy with no physical, and then once your health gets better, revisit and try to adjust
But
the
that's an
policy?
interesting question. So what I'm going to say, so I'm going to answer it by saying this. Having a policy is better than not having a policy. And nobody has a crystal ball who that knows when they're gonna go. Because guess what?
Mhm.
Totally healthy people die as well. They die in accidents, they die in all kind of stuff. So some people, I know a lot of young people have the mind state, well, I'm in great health. Like I was talking to a person who was interested in the policy. He ultimately didn't get it, but he was like, I'm in great health. I know I got at least 30 years left in me.
Mhm.
And I said, you know that for certain? Like I was just watching Steve Kerr talk about a shooting of a basketball player got killed out near high school. He was a basketball player, so I know he was in great health. He probably wasn't thinking he wasn't going to make it that day. So people have that kind of idea. So my thought on it is, again, having a policy is better than not having a policy, right? Nobody has a crystal ball and knows where they're going to go. I would say have a policy, and then if you want to get yourself in good shape and good health, do that while you have the protection there. Because what's the worst case scenario? You pass away. That's the worst case scenario, period. If you pass away without a policy, then your loved ones is not only going to have to come out of pocket to bury you if you don't have the money, but it's going to financially hurt them. If you get a policy, you could always say, okay, I want to, try for another policy and then cancel. You could always say that. That's an option for you. But having nothing, I don't think is a good plan for the worst case scenario.
So okay. So with that being said, I got a policy now. My health is great. So what do I do? Do I go and cancel that policy and just get a new one, or
Don't. So here's my first thing I'm gonna tell you is never cancel a policy
mhm,
unless
before
you
you go
have
to
another
cancel?
one in place,
Exactly.
because there's no guarantee that you're going to
Within that time.
qualify, because there's a
Okay.
qualification process, right?
Okay.
So I offer second opinions on policies because I know that there's all these policies out there that are very expensive and they don't do what they say they're going to do. So the one thing you want to know is the policy going to pay out? So there's this company called AM Best. They rate life insurance companies. AMBEST. And AM Best reports on, you could see like which companies pay out when people die, which companies you have to sue to get your payment from
Wow.
because they don't pay out. So this is how it works. And then it's like if a person have a policy and there's no conversation with the person who's listed as the beneficiary, you might not even know they have a policy. So all of these things come into play. But yeah, yeah, there's so many factors that has to be checked off when you're kind of doing this. But the first thing I'm going to tell you, never ever 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 cancel a policy unless you was issued a new policy. So when I work with people, part of most of my business is dealing with people who already have a policy. So I say, listen, I'm gonna give you a second opinion. I could look at the policy. There's no obligation to buy from me, and I'll just tell you from what your policy says what it does, what it's actually doing. I'll give you the facts about it, and then you make a decision. And I've talked to people who said, "Oh, after I showed them what the policy did, they was like, this is not going to work for me. I need something else." Then I'll run something and I say, "Well, this is what we could offer comparable to that." Then they move with it, and I work with other people who just said, "Nah, I'm gonna stick with this policy." And we're gonna talk about that a little later. It's about IUL, but we're gonna talk about that a little later.
Okay. Okay. So let's dive into it. You know what I'm saying? Let's
Okay.
um tell us everything. Tell us what we
Okay.
don't know about.
Oh,
We mentioned IULs, so let's just get into it. You know what I'm saying? Let's just
okay.
get into this and dive deep into this IUL, and then
Okay.
we could fade out into the other ones that that's
Cool.
about.
So IUL stands for Index Universal Life. That's what it stands for. And this word index is very important because my experience is it's being sold as an investment and a life insurance policy bundled in. That's my experience. So this is what I'm seeing. And I already said in the beginning that life insurance, IUL, whole life, and universal life, they're not listed under investment products for a reason. So I kind of gave you a little bit of information. I said in the beginning, I said that as you get older, it costs more for your policy to be issued because you're older, you're a risk. Each year you get older, correct? So
Definitely.
the cash value in your policy, if you got a cash value policy, is to cover that your policy costs more. So they're going to still charge you what you agreed to pay, and they're going to take the extra money. It's not even extra money because they put things called dividends, and a portion of your money goes into this account that accrues interest. How does it accrue interest? We're going to talk about that too. But the interest grows, so as you get older, your policy premiums, the deficit is going to come from the cash account. So let me give you an idea. I was looking at a policy where somebody's like, "Oh, I can have this policy until I'm 121," and they say that on most policies until the age of 121. Look at your premiums for a person around that age. The premiums is like $4,500 a month. You heard me right. $4,500 a month to insure a person around the age of 100.
Wow.
So that's coming out the cash account. They call it the cash value. Now, the cash value for IUL, I'm going to tell you this one specifically. I've seen many policies, IUL policies already. It's going to say on the first page when they actually issue you the policy. So here's the first thing. A person who sells the policy, an agent or a salesperson, is going to tell you all of these great things about the policy. And then when you get the paper, it's not going to match everything they say. I'm just going to tell you that straight up. So the first thing is they tell you the policy, the person says, yeah, is based off the S&P 500 and the global index fund. This is what they tell you when they're selling these policies, specifically IUL. When you get the actual policy paper, it's going to say probably on the first page, the money is not actually invested in the S&P 500 or the global index fund. It's going to tell you it's not invested in it. So what is it invested in? And then they're going to tell you about floors and caps. The floor is if the market does terrible, you're not going to lose any cash value. So it's a guarantee that you're not going to lose cash value. But the cap is if the market does great, you're not going to get all of the money from the interest rate. It's going to say something like your interest rate is capped at 13%. That means that's a maximum amount of interest you could get. But if this index funds do 28%, you're not going to get 28. You're going to get 13. That's what
So
it's
do
going
they
to
get
tell
the
you.
do they get the rest? Do they get the rest?
So that it's not each actually invested in the market. So that's the first thing I need to tell you. It's not invested in the market. So it's kind of mysterious because you have these people who write policies. Those are mathematicians and people who are like super deep with math. So I'm going to tell you a few things. Like you see this cash value, and they say by the time it gets to this, it's going to be worth this much, and da da da. And they tell you all of this. Your policies that generate cash is designed in a way that it's going to probably take you majority of your lifetime just for the cash value to equal the face value. The face value is what they're going to pay your loved one. It's going to take you your most of your life for it to get there because there's this rule with the IRS that it becomes a MEC. A MEC is like when you have something where your cash value grows so fast because you overfunded your account, they're going to start taxing you on the cash value account.
Really?
So life insurance is designed to slowly grow to get so here's another thing with these policies. You won't start breaking even with your policy, meaning your cash value is equal to your premium payments. That's what I mean. You won't start breaking even until 15, 20 years where those things are equal. Because somebody just called me and was like, Fahim, I want to get a whole life policy so I could borrow against it. And I was like, you're not going to have any legit cash value for at least 10 years. Like, that's not even equal to what the payments and it's not equal, but at least 10 years. So when people say, oh, they're telling me I could have $1 million, yeah, it's going to take you like 30, 40 years to reach that number. It's not instant. You don't get instant cash value. Cash value is over time, compound interest. So that's how it builds. But again, here's the real kicker that I want to give you. When people sign up for these policies and they see this cash value, that's the thing that motivates them to get the policy, because they're thinking, I'm going to have a lot of money. Here's the fine print. If you didn't check off on the box that says, I want my beneficiary to have the cash value plus the face value, what do you think happens? So you get a policy for $100,000 IUL, and they say in 30 years, 40 years, you're going to have $1 million in the cash value. You pass away prematurely, which one do you think your loved one's going to get? That's the question, because most cash value stays with the company. Wow. When the person didn't check that box. Most people don't check the box. And the reason why they don't check the box is because your policy is going to cost you more money if you want both to go to your loved ones. So you are, in essence, making a lot of money for the insurance company itself. They get to keep it. That's the thing that most people don't talk about. I took the same test they took. I'm telling you, I know how this works.
So I think we talked about this, and you said that IULs is basically for the rich.
I'm gonna correct that.
They benefit from it more.
Mm-hmm. I'm gonna correct that because that's what they tell us. They say wealthy people use it as a mechanism to grow their money. I was doing some research. Most wealthy people don't use IULs. And you know why they don't? Because they see it as a bad investment. They see it as a bad choice. The gains are minimal. Most IULs don't pay out 13% in the thing. And here's another thing I didn't mention to you, but I need to mention to you. IULs, they're supposed to grow with this interest and all of this stuff. You know, you put your money in and you're supposed to grow with all of this interest. These, I told you, they're non-investments because that's the classification by FINRA. They say it's not an investment. And I did tell you that you need this money to pay for your expensive policy when you get older. But how do you get the cash value out is the one I didn't talk about yet. I'm going to tell you right now. There's two ways to get the cash value out of your cash value account. You got to borrow it. So borrow it, first one, is going to automatically show you that you can't become your own bank if you're borrowing. A borrower is not a bank. A lender is a bank. Who are you borrowing your cash value from? You're borrowing it from the life insurance company, which means they own the cash value. That's what it means. So you could borrow it, and then this is what they do. If you borrow the money, they say, well, you have an option to pay it back at interest, or you have an option to not pay it back, and we're going to deduct it from the amount we're going to pay to your beneficiary. This is what they tell us. The second way to get your money out is to cancel the policy. Again, never cancel a policy unless you have another policy. That's number one. Number two, read the fine print. I have seen IUL policies that lock you in for 10 to 15 years. They tell you if you cancel your policy, you will get next to nothing in cash value, even though your account shows $20,000. If you cancel your policy in the 10 to 15-year period, you're going to get $1,500 or something like that. And you'll be like, wow, I'm going to lose 20 grand. So that keeps you locked in the policy. Keeps you locked in because you don't want to lose the money. not knowing that you're losing money. You're bleeding money because the policy is expensive. And then when you look at the different columns of the breakdown, you're going to see the price they're charging you to insure you. And then they're going to take some money and put this in this interest bearing account that they're also charging you to manage that account. That's a lot. So,
So
and then my other thing is like when you look at an investment. So let's talk about what an investment is right quick. You can ask me a question. Here's my version of an investment. I took a certain amount of money and I put it somewhere and it grew, right? That's my idea of an investment. These policies work the opposite. Look, you take a certain amount of money and over time you get cash. The money that why would you spend $80,000 to make 50? That's a loss. Keep your 80. You know what I'm saying? But this is how the policies work over time, and that's the problem. Over time, so if you say I want to get out of the policy, you run the risk of losing this cash value, which is the hook that keeps you in. And then if you get out of the policy, you're going to see that moving forward, you're actually saving money, but you got to have a policy to go to. You got to have one already set to go to.
so what the agents, why do they push it so much? I know besides the company making money, do the agents make money as
Their
well? I mean,
commissions are very high on IUL.
okay, yeah,
That
that's
makes
how I
them the
figured.
most money. So, and I want to make people aware of this because this is something that I feel that we don't talk about enough. And it's integrity, right? We had a housing crisis bubble. Remember that?
Yeah,
Remember when we had a housing crisis where the mortgages, people was giving people mortgages who should not have mortgages? You remember that? So there's business practices where you're supposed to say, there's no way this person could pay this mortgage. They're going to lose the house. And make a decision not to move forward with it because you're going to hurt the customer. That's not happening with life insurance. They're like, you can afford it, and therefore we're going to sell you something that we know in the long run is not a great product, but it's going to make me a lot of money to sell it to you. That's what this conversation is about. It's going to make me a lot of money to sell you a product. Now, I'm going to dig a little deeper into that. I'm going to delve a little deeper into what I'm talking about, a product that's not going to do the job. If you go to Google and you Google the percentage of what we call failures, which means the policy collapses and closes of IUL, it's going to say 80 to 90% of them fail, they fold, they collapse. 80 to 90%. Why? Because they're being told by a person, you should get the IUL, and they recommend and they take the cash out because that's to become your own bank, unlimited banking conversation. But when that happens, the policy, every policy works this way when you're talking about cash value. If you have $0 in the cash account, your policy is going to terminate. It's going to close itself. It needs a cash account to stay open. It needs cash in it. So what will cause it to terminate? What if the market is bad? Certain policies is worded that if you have an IUL policy and you're paying X amount of dollars this year, and you're paying X amount of dollars per month, and the market does bad, you have to add more funds to what you're paying and keep your policy open.
Mhm.
That's the problem. Because generally they're not going to tell you if you have cash in there in regards to the market doing bad. They're just going to take it out of the cash value. And you don't get to choose what the cash is invested in, the actual investment. You don't get to choose that. So the policies make more for the salesperson, for the life agent who's selling it to you. And the policies, again, 80 to 90% failure rate within the first 20 years. Now, Now that you mention that, I wanted to bring something up because this is a guy named Kyle Busch. He put out a video. He's a NASCAR legend. So we like, okay, you have LeBron, he's a legend in basketball in a sense. You got different people in basketball, you got different sports agents. This guy's a legend in NASCAR. And somebody convinced him to put $8.5 million in an IUL policy and it collapsed. He's on the, you could Google him right now. You could see him and his wife talking about it. They got a lawyer and they're suing the insurance company. It's not just him. People have sold their homes and somebody says, I don't have no retirement, but I got $1.5 million. And a life agent will say, put it in an IUL and then take the cash out of the cash value to pay the taxes for selling the home. And the person do that and they lose their $1.5 million that they put in the policy. These policies are very expensive, but you have people. So when they were created, they were not created for what people are telling people to do with it. They was never created for unlimited banking. They was never created for be your own bank. They was never created for these things. If you follow the way they're made, it's not going to benefit you the most, but it's more sustainable. But if you're borrowing money out and you're taking money out for all of these different things in the policy, that's a problem. The other problem is, again, front loading it. It becomes something called a MEC. I told you. When you do that, now the government's taxing you on it. But here's another thing they don't tell you. You said you was going to buy a home at one point. So when you buy a mortgage, you understand how mortgages work?
Yeah,
The
definitely.
interest, it's going to take you 20 years to properly pay. You paying interest and a little bit towards principal. That's how these policies are designed. So you think I put all this money, I put $1.5 million. You might think I have $1 million or something in my cash account. No, it's based off compound interest. This is an actual story. The lady who put the 1.5 million in, guess how much her cash account was worth? $89,000. When her policy collapsed after putting $1.5 million, she got a check for $89,000. Because it's based off time and compound interest. So I'm going to say for everybody who's checking this out, do not put a ton of money in your IUL, period. If you have a monthly payment that they say and you could pay that payment and you're going to stay with IUL, that's your choice. I'm going to say don't stay with it, but that's me. Because I'm a person looking at the economics of it. Do not
So there's
take wealth and pour it in it. Huh?
So there's no benefit of an IUL. Like there's who could benefit from using this? I mean, it's out there. There's people using it.
I could tell
So
you what they tell us, what they talk about IUL. I'll tell you what they say to people who benefit. Wealthy people who can't get a Roth IRA because they maxed out. They can't put money into their IRA. They need to put money into something that's going to get some level of interest. The IULs do tout that they'll give you some level of interest, but I guarantee you it's not the level of Roth IRAs and investments. It's not going to give you that level. It's not a win-win. It's a low return. And then that return again is over time. But this is what they tell us. When I was doing the research, it says a majority of wealthy people do not even go to IUL because it's easier for them to just go and invest. And it's it's a huge gain. They like 20x better, 20 times better than putting it in there. So what's the point of it? It's words they use to market the product. So like, I'm not going to get on food, but certain foods be like, oh, we taste great. And then you read the ingredients and be like, this stuff is bad for you. So there's products like that too.
Yeah, because what they say is this with the IUL, they market is that you could actually put the money in and take it right out, and it's like it's still there.
Nah. So all cash value accounts, everything that builds wealth takes time. And I'm going to say a decent amount of time, like 20 years for you to see significant gains based off compound interest. So I tell a lot of people, run a compound interest calculator and talk about how much you're going to put in every month and how much you started out with. It's going to take the longer it's in the investment vehicle, the more you're going to make. So if it's 30 years, if it's 40 years, it's going to be a huge number, but you got to start young. So this is why I tell people about, we also talk about investing in all of that, but investment is powerful. So we do something called buy term and invest the difference. Buy term and invest the difference means the money you would have spent on the IUL policy, get term, is going to be way lower. Our average policy with us costs $50 a month, average. And then you could say, I was going to pay 150, so I could take 100 and put it here in a Roth IRA that's getting 9%, and I'll leave it in there and just keep on putting 100 a month. That money will be far greater than whatever that IUL said they were going to give you. That's the issue. So IULs, their payout is not what they say it is for all the policies I've seen, but I'm going to say most just to keep it safe. They have something called the guarantee, which is the market is bad. This is what we guarantee you're going to give. Sometimes it's 0 interest. And then they have, this is what we project. This is what we say we think we could give you. All the policies I looked at, when they say, oh, other agents is going to look at it and they're going to always go with the guarantee. Well, all the policies that I looked at, now ask the client, call them to ask them how much your policy is worth. And they say, this is how much it's worth. And I look at both charts. That's in the guarantee chart. That's not in the projected chart. Expected. So they're paying you what's in the guarantee, but they tell people, don't listen to agents who tell you they're going to look at the guarantee chart. But when you look at the numbers, it's right on that range, which means they're not making money. Of course, I told you already, it's not your account. So you're making them money, but it's not for you, So yeah, that's we said a lot just now.
Yeah. But we talked about the bad. Let's talk about what you considered the best vehicle for consumers like looking into getting into life insurance. What your company,
To me, the best bang for the buck is term insurance.
term.
You pay for term, you use it for the term. And here's the thing that's important that you touched on. I didn't give you a full explanation. My company is different from a lot of companies. I'm going to tell you why. We don't believe that you should have life insurance policies for your whole life, in term life. We don't believe it. You know why? There's this thing called being self-insured. Who would be self-insured? Well, rich people would be self-insured. But what if we showed you something, which is invested in Roth IRA, that's going to make you wealthy so you don't need life insurance anymore? You know what we tell people to do? Cancel our policy. Cancel the policy, because guess what? You got $2.5 million now in your Roth IRA. You don't need $100,000 life insurance policy. You could take from your estate to pay for your funeral. People could just do that. Plus, you got money to pass on to your loved ones. People could just do that. So we teach people how to put their money in the right vehicles, how to live off a budget. That's important. How to get out of debt. All of this stuff is complementary to our clients. You come on as a client, we can help you figure out how to get out of debt with extensive tools that we have that we could put the numbers in. It'll spit it out. Pay this one first because the interest rate is here. Pay this much a month. You get out early. If you do debt stacking, we call it debt stacking. We could show them about getting the 3 accounts: the emergency fund, the short-term goal fund, the long-term account, which is your retirement. We help them with, all types of stuff. Mortgages, we have, not in New York, but we with Rocket Mortgage. We do prepaid legal. We have identity theft protection, Vivid Home Security. And for the investment side, all of the companies that offer investments like Vanguard, all of them, those are our partners. We could sell Vanguard's products, which is their investments. Their investment, they call them mutual funds. So we carry all of them. Invesco, all of them.
Yeah, so I know we talked about this before. You guys manage the portfolio as well.
So
So
we
when you
have,
say manage, so
mhm,
when you say manage, is it to the point to where, okay, the market is dipping, so we're gonna take the funds and put it more into mutual funds or gold, or I'm just saying things right
right, right.
now,
So
more
so I'll clear that up for you.
less riskier
So we don't do commodities.
assets.
Nobody, no,
Mhm,
we don't do commodities, but we have these mutual funds. With a mutual fund, the ones that we offer are managed. So what does that mean? We're not doing the management.
mhm.
Um, what's it called? Vanguard is doing it. Invesco is doing it. So a mutual fund. So I don't know if, like, when people want to say they want to invest. Let me give you an example. They say, I want to invest in Tesla. Tesla is one company. What happened if Tesla stock drop? You lose money. You're going to absolutely lose money. And let me just say, in investments, expect to lose money at some point. You might, you just, there's a high possibility that you're going to lose money. But when you do a managed mutual fund means there is a person who's in charge of the fund. And the other great thing about a mutual fund is diversified, meaning it just doesn't have Tesla. It has 150 companies like Tesla in it. So if one company does bad, they could take that company out and replace it with another company to keep your portfolio gains stable. That's a managed mutual fund. And I'm going to say that they're not all created equal, because I'm going to tell you, banks have them. They don't offer the interest rates we offer, the gains that we offer, because the banks got to get their cut. So they're going to offer something that's a lower payout. You have other places that offer them, not going to be great. People say things like CDs. CDs don't even, to me, this is my opinion, but I researched this stuff. The inflation is what, 2.5, 2.75. CDs is like, they don't even beat inflation. So in my opinion, to get a CD is, you could be losing money. Certificate of deposit. So you want something that's doing 9% or better. That's what you want. So we offer those kind of vehicles for people if they're interested, and it's tailored to the person. So we do like this whole analysis, ask you all these questions. What kind of investor are you? Are you a conservative? Are you risky? Are you moderate? And then we ask, well, what are the things that you think you want to invest in? What is the things you causes? Like some people's like, oh, I believe in saving the whales and the wildlife and the ocean life. Well, we could, if you could find something like that, or I believe in clean energy. I believe in solar energy. So we will research those things for them and come up with three options for them and say, these are the different funds that match that, and this is their history. So then you get to move on that history. You get to say, okay, I want to be in this fund. I want this fund right here. So these are things, investing, it takes a certain amount of knowledge. You don't have to be a rocket scientist, but because it's a managed fund, you got a smart person on the fund who's making sure you do well.
That's the job.
As opposed to buying a single stock and then tomorrow it tanks.
Okay, so we haven't mentioned who you work for. What's the company name? Do you mind sharing with us the company?
Yes,
And it seems
I
like it's
can
a
tell you.
one-stop shop.
Yeah, so the company that I work with, I'm a team member on, is Primerica, and we had this conversation off record, but they say, oh, sometimes a lot of people had this conversation with me. Oh, the reputation back in the day. I'm here now. I know my reputation. And my reputation is highly important to me. The team that I'm with has a great reputation. And I just wanted to clear a few things up. People say things like Primerica is a pyramid. So pyramid means to me like pyramid scheme, like it's a scheme. Well, would you think FINRA and AM Best and Forbes magazine would say we're the best company if we was a scam? Like there's records of them saying that. And if you type in Google what a pyramid scheme is, that's a scam. We're not scamming people. We are offering a great product or great products for low cost. So our motto is client first, client above everything. What does that mean when I say client first? That means if I'm talking to a client and they got a great life policy and it's doing what it need to say do, what they say they need, why would I tell them to cancel it? Why would I tell them to get one from us? What's the point of that? It's a great policy. So, and I'm not saying we have the best, but I'm saying we have very good stuff. So also making suggestions to them, not because I want to make a whole lot of money off them, is what they need. What is your need? Can I give you the best advice and not make that advice biased because I want to make a sale and make a whole lot of money? That's the difference to me. There's things like we offer with our policies, and there's other people who do it well, but do it as well. But they have this thing called a living benefit with our policy. So we say that our policy does not have cash accounts, and they don't. They don't have cash accounts. But we have this thing called a living benefit. If a person gets terminally ill and they get sick, we will give them a portion of their policy, no strings attached. 40% in one instance, 70% in another instance, that they can use it for alternative medicine, alternative treatment, whatever they need to do with it. With a term policy,
Wow. I never heard
there's
that
no
before.
cash attached to it. So a person come down, they hear 15 years, whatever, and they come down with cancer. And they have a policy for, they have a policy for, I'm just going to throw out a number like $1 million, right? We will give them $400,000 from their policy while they're alive to do something with it. Another thing with us is we don't have a war clause in our policies. What is a war clause? 9/11, act of terrorism. Do you know that when the president got up and said that was an act of terrorism, war clause kicked in, and a lot of insurance companies did not have to pay out to the people who died in 9/11 because that's in their policy? We don't have that in our policy at all. So there's benefits, to being with us. But I'm gonna tell you, being with Primerica forced me to improve myself. I'm reading all kinds of books. I'm changing my mind state on stuff. So our education program is called How Money Works. They say because money don't come with a manual, but they can give you some pointers and point you in a direction and say these are ways that we could use money, and these are the ways to keep money, and these are the ways to lose money. And so that's a roadmap for how to handle money. I would have never known this stuff if I didn't go pursue this in this manner. And mind you, I'm a college professor teaching computer science, cybersecurity. I know stuff, but I didn't know this stuff. To me, this is more important. To me, this transcends everything. People in sports need it. People in entertainment needs it, and music and actors need it. I was just watching the Eddie Murphy thing, and he was talking about how he buried Red Fox and paid for the tombstone of this person. Like, where was their money? Everybody needs
Yeah.
this.
No, definitely. And you seem like you're doing a service, a great service, you know.
That's my main thing. I'm not trying to I'm not trying to be the salesperson of the year. I'm not trying to make people just buy from me. I want to educate. Education is the key point of it because we don't know this. And like I was saying, I mentioned to some before, 4 people I know passed away in the last 3 weeks. 4. 2 of them was under 45, and 1 of them was a mentor of mine. So you don't know when you're gonna go, but my thing is having a conversation and having the educational component. We need to be teaching our children this stuff. Our children should not be starting out at square one like we started out. Some of us started out at 0 or in a hole because we had to come out of pocket for something. You know, our children should be climbing on our shoulders to get to the next level. So how do we ensure that? We have to have them properly educated on how money works.
Man, we covered a lot today. We covered a lot. Before you go, can you um give some words of wisdom on that you think that you feel that that everybody should do?
I'm gonna say this, and this is one of my missions, and I've been struggling with it only because it's not panning out to be successful, but in the sense of the goal, at least one person in every family should have a level of financial literacy. They should be at a certain level. So in my mind, I'm like, I meet a person, they say, "Oh, I need a policy." Boom, boom, boom. I'm always asking them, "Yo, did you think this is something you could do from Zoom? Because it's a Zoom based business. I don't have to go to anybody's house because my thing is not. I don't make a money directly off of a person I bring in. I don't make money off of that. I get a promotion depending on how many, but I don't get a check, right? But my thing is this: you be that financial person for your family. Because some people have this mind state like, I own a business, it's got to be all me. No, if you own a business and you're doing all the work, you own a job. You got to be able to help other people make money. So you own a business, you hire other people, they in turn can own a business, right? They can hire other people. That's appealing. And a lot of people say, "Oh no, that's I want the security of my job." And I'm not beating up on jobs because I have one. Everybody have jobs. If you don't have wealth, your job is going to be the thing that's going to allow you to get the wealth, right? So let's not get down on jobs. But guess what? Your job, you work a job like my dad. I'll use him for example. He worked for transit. He retired. He couldn't march one of his sons up in there and say, "Give him my job." Right? He couldn't do that. And then all of that hard work and stuff that he put in is not his business, it's somebody else's business. He couldn't train us in elevators and escalators to pass. This is a business that you could actually train somebody in. You can train somebody in it and you're incentivized to train somebody in it. Because on a regular job, you train somebody, they replacing you 9 times out of 10. That person you train taking your job and you gone. But this job here, this work here is not a job, but this work building a business here, I could help somebody build them up into my level. They could branch out on their own. And that person and myself build a business that I could leave to my daughter. Can you imagine that? You built a business in life insurance and you're ready to say, I'm done, or God forbid I pass away prematurely and I built this business, my wife is going to get a check for the rest of her life because of the business that I built. Can your job do that? That's the thing. So we talk about generational wealth and passive income, and we talk about these things, but we don't really put a hand on it. This is how you build passive income. You got it where your business is running. You got a people who you trained, and then they got people, and they all got out and spread out and made their own business. And let me make this clear: I'm not getting no money directly from them. They're not cutting me no checks. The business that I'm under, Primerica, they're cutting me the check. I never come to a person and say, I just did this blah 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 with you, hear me, give me $200. I never ever do that. Nobody ever hands me any money. But the business is like, you did this much work. This is how much we're going to pay you for the policy. Boom. This is how much we're going to pay you for the investments. Boom. Oh, you got this many people you train and they working and they doing it. Here's a bonus because you trained them and they doing good. And then they encourage to train people and do it. And then they get a bonus too. You see what I'm saying? This is something different. This is not the regular 9 to 5 grind. And again, I'm not trashing 9 to 5s because I got one. I got a regular job. This allows me to pay my bills until I get to the level I need to get to. But realistically, no job that I know is going to allow me to quickly build myself up to a high level of pay and then pass that on to whoever I want to pass it on or sell the business. No job does that because I'm working for somebody else.
All right, Fahim. So sounds excellent, man. So where could the people get in contact with you if they want to learn more about Prime America and join the team?
Okay. Primerica. I used to say Prime America when I used to get it, but it's Primerica.
Yes,
But
Prime America.
I would say so. I'm gonna leave my email, my phone number. I'll leave my phone number. That's the best way to catch me because call me or you text me, right? But I'm area code 917.
Wait. Well, this is a business number because you don't want to give everybody
No,
your number.
this all right. This all right.
Okay, all
It's
right,
all
fine.
right. Area code 917-364-8053. So that's that. Then I'll give you my email. I have my email, Faheem, Faheem .Abdulrazak, like you see down here at the bottom, and then my name is on the tag, at Primerica.com, Primerica.com.
Is there any social media?
I do, but that's under my personal name, so I don't have anything under my Primerica name, but I'm on Instagram under a different name. I have a company name under YouTube, so I'm into music and all that stuff too. So I'm an artist, I'm a hip hop artist and all that. But I'll just leave those two. You can find me on LinkedIn under my name with the Primerica information. So under my name for LinkedIn.
Okay, so at the end of this live, we're gonna put all the information on the bottom of it.
Cool.
Post interview, so everybody could know where exactly to go to get in contact with you.
Awesome.
Man, this was great. It was great. Some great information, some gems. Appreciate you taking the time and letting us know all about this insurance game and how not to get caught up with the wrong policy.
Yeah, these insurance companies, and I mean, their businesses, they make a lot of money, but I believe they're making a lot of money because people are misinformed. So people go for things that are recommended or suggested to them because they don't know any better. And that's the issue. So we say you go to a doctor and they say, oh, you got a cough, you got to do surgery on your knee. Get a second opinion, right? Get a second opinion because this person is probably looking to get paid. So sometimes you got to talk to different people. It's like, listen, I'm going to look for this insurance policy. You have this thing called the 30-day look period where you get a policy and you got 30 days to say, I want it or not. So you could, if you qualify for that company, you could qualify for another company. You could compare them and see, what's the best deal. And I'm open for people reaching out to me because listen, you don't have to buy from me. I'm not gonna try to twist your arm and give you all the sales tactics to get you to buy from me, but I will give you my honest take on it, and I can back it up with numbers because I'm going to run some numbers. And I'm going to say this is how much you're going to pay in premium for this period of time, and this is how much your cash value, and they ain't matching up. I'm going to tell you that, and then again, I'm going to make you aware that you don't own the cash value unless you check that box. They own it. So this is why they push these policies because it's like making money on top of money. So they smiling and they telling you, yeah, you're gonna have millions in this IUL. What they really mean to say is you're gonna make us millions with this IUL. That's what they really want to say, but they can't.
So Primerica doesn't sell IULs at all.
Primerica only sells term.
Primerica, yeah.
Yep.
Okay.
Only term. That's it. And this is why a lot of companies get at us. Like technically, companies was trying to put gag orders on us. So we don't talk about what we do because they say if we come out and we say certain things, some companies say if we come out and say certain things, it's gonna hurt their bottom line because of course they're selling the policies that we don't recommend. We only recommend the one product. So people say, I heard people say, oh, Primerica is limited because they only offer this. Well, if we showed you how to buy a term and invest the difference and make 5 to 10 times the money that these people are claiming you're going to make, why wouldn't you go with that option? Like, unless you just want to give away money. Right? Why would you want to say, no, I want this super, super expensive version of the same product everybody else got. I just want to pay more for it. Or this is an inferior product that I want to pay for more for when there's a better product over there for less money.
Makes sense. Makes sense.
Yep.
Well, Fahim, like I said, man, I really appreciate you coming on and giving us all this information about life insurance and sharing your views on it. So definitely, hopefully you come back again. We'll do this again another time. We maybe another product that your Prime America is is providing, and definitely we'll do it again.
Okay, yeah. Thank you for having me. This was a great opportunity to educate, and I do. I talk to community centers and people, and we got to educate people to not stay in the cycle of poverty, stay in the cycle of bad money decisions. And I want to say it's not just us, right? We're not the majority, but it's happening to like everybody because they don't know. So I'm looking forward to getting on again if you have me, and thank you.
I appreciate it. So,
All
all
right.
right, people, thank you. I know I'm new to this. This is my first video, so like, share, and subscribe. I know I gotta get better at
Yeah.
it, but
It's all
if you want to
good.
hear more information, if you want to hear more information about life insurance, please reach out to Fahim. And if you want to get see stuff like this, I'm gonna have it on my YouTube. We're gonna talk about health, wealth, and prosperity, and all this is all my channel is all about. So it's just to educate people to live a better life and to do better. So hopefully you join this journey with me on this YouTube channel. So I appreciate you
Awesome.
for everybody that stayed on for this. It's over an hour, but it was a lot of information. Hopefully you guys found value in it. And thank you.
Thank you.
All right, fine.
All right. Have a good night.
All right.